Hello friends, my name is Ashok Sen Gupta and today topic of discussion is dividend model, and it is a continuous series, and today I will discuss the dividend model part 3. I am associated with School of Management Sciences, Lucknow. So, in previous classes we were discuss about the dividend, their determinants. Now, in today's class we will discuss about the model. In previous class also we discussed about the irrelevant model, where I was discussed about the theory of irrelevance like residual theory and hypothesis model. Today we will discuss the other theories which are related to the dividend model. So, relevant theories of dividend models have designed to argue that the dividend decision affect the market value. The market value of the company. Some of the school of thought said there is no impact on that. So, relevance theory of dividend decision argues that dividend decision affects the market value. Irrelevance said there is no impact, relevance said there is an impact on market value. This theory suggests that investors are generally risk averse and they would like to get their dividend today as bird in the hand is better than in a bush. They expect the possibilities and they of return and they required return today. Then dividend relevant theory proposed that dividend affect the share prices. Therefore, if company not able to pay the dividend today, it will hamper the share prices of the company, it will affect the share price of the company. Okay. Company's goodwill is depend on dividend, what he is paying today. If company offers to get the dividend in later on or in future period of time, that will always affect the company's shares and market value. In this approach, we will discuss today Walton model. There are basically two important model, Walton model and Gordon model. So, I will discuss here first Walton model. The Walter approach was given by the James E. Walter, and it is based on the simple argument that where the reinvestment rate, that is rate of return that the company made earn on retained earning is higher than the cost of equity or return to the shareholders, then it would be in the interest of the firm to retain the earnings. It says if company reinvest some value for its future investment, and that value, that rate of return is higher than the cost of capital, it would be interest of the company to retain, then company can retain its fund. If the company's reinvestment rate of return is less than the cost of capital, the company should not retain it. If the two rates are same, then company should be indifferent between retain and distribution. So, there are three aspects, either R greater than KE R less than KE or R equals to KE. There are 3 cases. So, R is rate of return of investment, K is cost of equity. So, if company invest in higher rate of return than the cost of equity, then only then company can make retained earnings. If it is not possible, if rate of return less than cost of equity, then company cannot retain earnings, do the retained earning process. And third is, if both are equal, then company have to take decision, either have to retain or give the dividend to the shareholders. Walter model is based on the following assumptions. First, the firm finance its entire investment by means of retained earning only. First assumption is company can make retained only earning to finance the things. Only source of finance is retained earning. Second, internal rate of return R and cost of capital K of the firm remain constant. Here it is remain constant, it will not fluctuate, it will not varies. Third, firm's earnings are either distributed as a dividend or reinvestment. There are only 2 options, either distributed or reinvest. Fourth, earnings and dividend of the firms will never change. Earnings and dividend of the firm will never change. And last, company has a long infinite life, company life is infinite life. So, these are the some assumptions of Walter model. Now, come to the formula P. Here the formula is P equals to D divided by K minus G. So, P is price of equity share, D is dividend paid, K is cost of equity and G is growth, expected growth of earning. It was a formula. Professor Walter has given the following formula to ascertain market price of. So, this is a general formula and this is the formula given by the Professor Walter, where D equals to R E minus D divided by K E whole divided by K E. So, R is internal rate of return, E is earning per share, D is dividend per share and K is cost of equity, K cost of equity. So, this is the formula given by the Professor Walter. So, we can do this theory or prove this theory with the help of numerical. So, here a question is rate of capitalization K is 10% equals to 1.10, earning per share 50 is given here, rate assumed rate of investment R varies 12%, 8% and 10%. These are the 3 cases where R is greater than K, R is less than K or R is equals to K. Question is, show the effect of dividend policy of the market price of the share applying Walter formula when dividend payout ratio is 0, 20%, 40%, 80% and 80%. So, first make it clear that dividend payout ratio means how much dividend you pay. In first case there is 20, in second case first case 0, second case 20, that means you pay 20% and retain 80%. In third case 40%, that means you pay 40%, retain 60%. Next 80, pay 80%, retain 20% and remain 100, that means you pay all the dividend. So, in all the cases we have to apply the formula and put the data and see what happen when r equals to greater than return k. So, I just do it on the here. In first case I solve it, okay, I am going to solve it. Question P equals to D divided by K plus R plus R E minus D, close the bracket, divided by K, close the bracket, and whole divided by K. So, in case 1 R is 12%, case dividend equals to D equals to 0, D equals to 0. So, put D equals to 0, KE 0.1 because it is 10% plus R is 12%, 0.1, 2, earning is 50, dividend pay is 0, divided by 0.1 whole divided by 0.1. So, this is 0, 12, 6 divided by 0.1 whole divided by 0.1, 60 divided by 0.1 is equal to 600. Yes, this is 600. So, in first case when R is greater than, KE and you are not paying the dividend, the value of P is 600, price of the share is 600. Now, similarly, I do the same question with R is less than K, R is 8%. So, formula is, we know the formula, D divided by KE D divided by K plus R E minus D divided by K whole divided by K. The case is R is 8%, R equals to 8%, 0.08 and dividend is 0. So, dividend is 0. So, here D equals to 0 divided by K 0.10 plus R is 8%, 0.08, E is 50 minus D is 0 whole divided by 0.1 and this is 0.10. This 0, 0.08 into 50 is 4 divided by 0.10 whole divided by 0.10 is equals to 400, Okay. So, this is similarly we find out when R is K is equal to R is equals to K E. So, here answer will be 500. This is the case when R is when case is 0, when we are not paying the dividend. Now, when you are going to pay the dividend, I take the example, I take this case 40%. Okay. D equals to 0.40, D equals to 0.40. Formula P equals to D divided by K E plus R K E minus D divided by K E whole divided by K E. So, in this case dividend payout ratio is 40%. Dividend payout ratio is 40%. So, D equals to how much dividend you paid? 40% payout ratio. So, earning is 50. So, 20 divided by point K E plus R. R is here I take the R 12%. Earning is 50, payment is 20 divided by K E whole divided by K E, 20 divided by 0.10, 20 divided by 0.10. So, here first open the bracket 50 minus 20, 30, 30 into 0.12, 36. So, 30 multiply by 0.12, 360 is equals to 3.6. divided by 56 divided by 0.10, 506. So, answer is 506. When you pay the dividend 40%, when you are going to pay the dividend 40%, the answer is 506. So, in this case you see that when we increase the dividend payout ratio, the value decreases, and here at 100% payout at all cases the share value price is 500 remain constant. In this case also when R is equals to K, the whatever you either pay or dividend or not, you pay the dividend or not, when value of R is equals to K E, then the P value is 500, 500, 500. Okay. When you pay the dividend is 0, then it was 500, and you 100%, then it was 500. Therefore, we conclude that R greater than K, we conclude that when R is greater than K, the company should retain the profit, that is 12%, R and K is 10%. Company should retain the profit. When R is less than K, the payout should be high, and when R is 10% equals to K, payout do not affect the market price. See, I again show you, when R is equals to K, there is no effect on market price. When R is less than K, payout should be this, and here when R is greater than K, the company can retain amount from its profit after paying the dividend. So, though it can take the decision to retain some amount and pay some dividend. This is another example. XYZ earns 10% per share, rate of capitalization 10% and 12 respectively. Determine the optimum dividend payout and the price of the share at payout. So, what is the earning? E is 10 and these are the, this is Ke and this is R. So, what we do? This is the formula, P equals to D divided by K plus R E minus D divided by K whole divided by K. Here dividend is not given. So, D equals to 0, K 0.1, R is 0.12, E is 10 rupees, dividend is not given and K is 0.1. So, it is 0, .12 into 10, 1.2 divided by 0.1. So, answer is at this point, when D is equals to, the payout ratio is the price of the share is 120, the price of the share is 120. So, the optimum of the optimality of the above payout ratio can be proved by using 25, 35, 75% payout. So, at 25% payout, you see I write 25%, that means 10 into 2.25%, 10 is earning. So, dividend pay is 0.25. So, dividend we pay 0.25 and we find out that new price is 1.115. At 50% payout, price decreases 110, 115 and 100. These are new price ratio of the different payout. So, payout has effect on pricing, through this we can prove that. So, hence with these two numericals, it is quite clear about when company give the dividend, it will affect the share prices. This theory given by the Walter, he said there is a effect of share price on share price, which is directly related to the dividend pay. So, in case 0, price of the share per share is 120, when payout ratio is 25%, that means company pay 0.25 rupees per share, then price of the share decreases. At 75 it is 105, and a 100 payout ratio, that means you pay total payout and retain nothing. The price of the share will hamper by 100. Therefore, company should maintain the optimum payout ratio where it is quite clear to understand when the payout ratio is optimum. In this case, whatever the company's requirement. In previous example, when R is equal to KE, price of the share remain same, price of the share remain same, and when R is greater than KE, then price of the share have differences from 0 case to the 100% cases. At 8% it is also increases, look, from 0 to 120, 180, 40. So, company need to pay. Okay. So, dear students, in today's class we able to understand that what is the theory of Walton model, how it is proved, how a dividend payout or dividend impact on the share prices. So, I hope you understand this topic. To calculate the Walton model, these are some references for your convenience. Hope you understand this video. Thank you for watching.